Hello everyone. Good morning, good afternoon, good evening, depending upon when you're watching this video lecture. In the earlier sessions related to the head of income from house property, we discussed about charging section 22, computation of annual value 23, and deductions under section 24A and B, and some of the intricacies in solving problems in different situations like vacancy, unrealized rent, and also self-occupied property or unoccupied property, and what kind of restrictions are there in terms of 24B in relation to the self-occupied or unoccupied property. These are all provisions related to income from house property we discussed in the earlier sessions. Let us continue with very few more provisions in this topic. One of them is section 25, that is inadmissible expenses or deductions. There is only one major thing, particularly interest that is payable outside India shall not be deducted. Shall not be deducted if TDS has not been cut on that payment. So the concept of TDS is something which is important and to be known at various levels. Tax deducted at source. What is that? That is the tax deducted by payer of some amount while he pays this to payee. And understand this core point here, conceptual point. Provisions related to TDS are all contained in a separate topic. We'll discuss that much later at the end of the discussion on the subject of income tax. But concept of TDS is to be known. What is tax deducted at source? Whoever it does. Let us say an employer deducts tax from employee. He can do that. He has to do that actually. What is that? Who is the income earner there? Income earner is payee. In that example, employee. But who is cutting the tax? Payer. In that example, employer. What the payer will do after cutting that TDS? He has to pay to government. But on behalf of whom? Payee only. But who has already borne this? Payee only. Payer is only like a postman. He is only cutting the tax while giving some money to the payee and giving it to the government. So the tax is not related to the payer. It is definitely related to the payee. But still, the tax deduction is being done by payer. So any income earner is normally supposed to pay tax to government. But because of these TDS provisions, not the income earner. Income earner anyway will be liable to pay tax at the end of the year once the assessment is done. But even before that, while the amount is just getting paid by the payer to payee, the payer has to cut tax and pay to the government. In other words, the tax is paid to the government on a regular basis as and when the income is earned. But who is paying it to the government? Not the income earner. It is being paid to the government by the person who is giving that money to the income earner. So that is the concept of TDS, tax deducted at source. Here what is happening? Who is the income earner? Income earner is somewhere outside India. Income earner is outside India, right? Who is paying it? Somebody in India, naturally, who is our SASI. And it is the duty of the SASI whenever he pays interest. Which type of interest we are talking? Of course, the interest related to the income from house property here. The interest on the loan that is borrowed for the purpose of income from house property, for which there was a deduction available under section 24B. For that, this is an exception, we can say. So 24B gave deduction. 25 says no deduction. When no deduction? At the time of payment or as per the requirements of the TDS provisions of the Income Tax Act, if the payer, who is the payer here? SASI. SASI is not the income earner for this interest. For this interest, somebody else who is outside India is the income earner. But SASI is claiming deduction. SASI is claiming deduction as an expenditure. Interest is an expenditure for the SASI. Our SASI who is having income from house property. For him it is expenditure, means for somebody it is income. Who is that somebody? That somebody who is outside India. And this SSE payer of that interest, while giving that to a payee who is outside India, has to deduct TDS. That is the obligation, legal obligation of the payer. It may sound strange, but that is law. Obligation of payment of tax and obligation of bearing the tax should be same as far as direct taxes are concerned. But we have to understand the difference here. Though income tax is a direct tax, assessment and payment are not same. Assessment is done always on the SSE. Payment of tax need not be done by SSE always. It can be done by somebody else who is giving that income to the SSE. In this case, the person who is giving the money is the person who has paid interest to somebody outside India, and while doing so, according to the provisions of Income Tax Act, he is supposed to cut TDS. If he does that, there is no problem. Why we are talking about inadmissible deduction here? What if he did not deduct that TDS? So the tax has not been paid or deducted from such interest. So if TDS was not cut while paying such interest when outside India, if that was not cut while paying it inside India, there is no problem. Then there is no inadmissibility. That is normally allowed as deduction under 24B. But in case the interest payable by the SSE here to somebody outside India, while doing so, if he did not cut the TDS, then that means he has violated the Income Tax Act. Of course, some other provisions will apply later, but definitely what is the first punishment he will get? What is the first punishment he will get is such expenditure is inadmissible. Expenditure is allowed as deduction. Logical things we have to understand. This is a basic common point everywhere in the Income Tax Act, except salaries. All other cases, the logic is same. What is income? There is something like revenue. In this case, in our chapter now, income from house property, that could be gross annual value or net annual value after the deduction of municipal taxes. From that, there are some deductions available. 30% deduction has no logic. That is what law said. But 24B has a logic. It is a real expenditure. So when real expenditure is allowed as deduction, the conditions prescribed in law have to be also followed for claiming the deduction. What is the condition here? If you are paying interest outside India, you have to cut TDS. Yes, no problem, claim deduction. No, no deduction. So what does it mean? Indirectly, though the real expenditure is incurred by the SSE, he is not in a position to claim deduction, which means his income will be higher. Of course, he has to pay higher tax later. So the point of giving a punishment is coming here, not in other forms of penalty or other things. Simply by disallowing such expenditure, some bit of punishment is given to those people who did not cut TDS while paying the interest to somebody outside India. And also in respect of which there is no person in India who may be treated as an agent. For example, if the other person outside India has an agent in India, there is no problem. But if there is no person like an agent for that outside Indian person in India, then this deduction of 24B is not available. That means section 25 will be invoked. That will become an inadmissible expenditure. So it is all in a nutshell. Interest expenditure is disallowed if that interest is paid outside India without deducting TDS. That's all. That is section 25. Then section 25A is very important because in any question this can be an additional point. In every question of income from house property, one more just additional point can be added in the form of 25A. Nothing special here, just taxability only. Arrears of rent and unrealized rent. Earlier it was unrealized and earlier it was not received by the SSE. Now it is received subsequently. So arrears means some due rent earlier which was not received by the SSE and which was not taxed earlier. So if at all it was received as arrears from a tenant or in the form of unrealized rent, if it is realized subsequently from a tenant, that shall be deemed to be the income from house property in the financial year in which such rent is received or realized. Earlier it was unrealized, now it is realized. Earlier it was not received, now it is received. So now it becomes taxable simply. So now it will be deemed to be the income from house property. Naturally, it should be included in the income of the SSE under the head of income from house property. But main point here to be noted is this taxability occurs whether the SSE is owner of the property or not in the financial year. If the SSC is owner of the property also or not also, still it will become taxable. So this is the main point here. Remaining things are just simple. When it is received, it is taxable. When it is realized now, it is taxable. Taxability wise, it is straightforward. But the point is, one of the conditions under section 22, which was a charging section, told that SSC should be owner of the property. But this is an exception to that. SSC here need not be owner of the property in the previous year in which he has collected some rent which he did not collect earlier, and he has realized some rent which he could not realize earlier. So now it becomes taxable irrespective of whether the SSC is owner of the property during the previous year or not. That means, let us say one person has sold the property 2 years back, but in the previous year he collected some rent related to that property which was due maybe 6-7 years back. That time tenant could not pay, did not pay. Now the tenant comes back and pays. So this SSC cannot say, I received that, but I am not owner of the property, so I will not pay tax. No, you cannot tell that. Even though you are not owner of the property, now, if you received any rent in the form of arrears or unrealized rent which could not be collected earlier but now collected subsequently, that shall become taxable. That is the main point. Ownership of the SSC during the previous year is immaterial. And another important point here is there is a 30% deduction that can be claimed on the rent that is so taxable. Which rent we are talking? Arrears of rent or unrealized rent. So simple summary of 25A is this. Of course, it is taxable in the year of receipt or realization. Second, deduction of 30% of the rent received or realized is allowed. Other deductions are not allowed. Only 30% deduction is directly allowed. And third, it is taxable even if the SSC is not the owner of the property in the year of receipt or realization. That is section 25A. So 25 is about inadmissible deduction. There is only one. That is interest paid outside India without TDS. Section 25A is unrealized rent, earlier unrealized, now collected. Arrears of rent, earlier it was in arrears, now collected, now received. That becomes taxable. But while doing so, there is no necessity that SC should be owner of the property during the previous year. Also, deduction of 30% shall be allowed. That's it. That is 25A. These are the major sections as far as computational aspects of income from house property are concerned. Let us quickly go through illustration 10. Mr. Anand sold his residential property in March 2020. Before even the beginning of our previous year, he sold the property. So is he owner of the property during the previous year 2021? No, he is not owner of the property. In June 2020, he recovered a rent of 10,000 rupees from Gaurav, to whom he had let out his house for 2 years long back, from 2014 to 2016. Whatever happened, that was a past flashback story. He could not realize 2 months rent of 20,000 from him. To that extent, his actual rent was reduced while computing the income from house property for that particular year when the calculations happened. We know that when unrealized rent is there, which is genuine, it can be reduced from the actual rent received or receivable, which it did. Now what happened? Though he is supposed to get 20,000, Gaurav is still not paying full amount. No problem, whatever it is, we don't care. Oh, now how much Anand is receiving, our SC? 10,000 is receiving. So it is what? Unrealized rent earlier, now being realized. How much? Not 20,000. Only 10,000 is being received. Due was 20,000. But now this Gaurav came back and gave 10,000 rupees to Anand. It is taxable, as simple as that. So 10,000 rupees is taxable under 25A. Further, he had let out the property from April 2016 to February 2020 to Mr. Satish. In April 2018, he had increased rent from 12,000 to 15,000 rupees per month, which was subject matter of dispute. In September 2020, the matter was finally settled and Anand received 69,000 as arrears of rent for the period between April to February. We don't have to calculate all that. Doesn't matter also. There was a 3,000 rupees per month rent increase. Okay, whatever it was, that also doesn't matter. This is all the dispute which happened. When the owner has increased the rent, maybe the tenant went to court. After that, finally court told that the tenant has to pay this rent to the owner. By the time court gave the order, already owner is not the owner. He sold the property. But still, he was the owner when he was supposed to receive. So now what is important is how much he received. That matters. How much Anand received. So what is this case? This is arrears of rent. So arrears is something which is originally not received, now received. Why that happens? Generally because of a court dispute which gives a judgment retrospectively. and all those past dues also has to be paid by the tenant to the owner. And like that, the tenant, whoever this Satish, has paid Mr. Anand 69,000 rupees as arrears of rent. Simple. What is that? That is taxable also. So 10,000 rupees is also taxable, and 69,000 rupees is also taxable, both under section 25A. So total taxable amount is 79,000. But there is a possibility of 30% deduction. That is the main point. 79,000 is taxable, but 30% of that is allowed as deduction, which means how much is going to be the income from house property of Anand for the assessment year 21-22, 55,300. That means he will be having income from house property even though he is not the owner of the property. Anand doesn't own this property during the previous year. So according to 22, there is no attraction of income from house property head at all. But 25A clearly mentioned that, which is an exception to 22 in one way. There is no need that the SSC should be owner of the property when he collects the unrealized rent or arrears of rent. It will be still taxable. So entire 79,000 will be taxable. Of course, the 30% deduction is possible. That's it. That is about 25A. And there is one more scenario here, section 26. That is co-owned property. Section 26 is co-owned property. We can just go to the summary of that because the essence of that is only important. Actually, we are not going to do anything. If it is a let out property, there is nothing special we have to do. Co-owned property means what? Same property owned by many people. Imagine there is one building which is owned by 3 brothers. So all of them are jointly owning the property. So what is a great thing that we have to do? We have to split every calculation into 3 different types. So it is as good as 3 different properties. We have to do the computation. That's all. Nothing else. Data will be given for the house. We just have to split it for 3 different SSCs completely, because these 3 are different individuals, these 3 are different SSCs, though they are owning the property jointly. So it's an arithmetical exercise. Simply, every calculation has to be split in accordance with what? The percentage of ownership. Imagine if it is owned equally by them. For everything will be 1/3, 1/3, 1/3 to each of them, like that. So if it is a let out property, there is nothing much. So the income from such property shall be computed as if the property is owned by one owner. First we have to calculate for the entire house. Then thereafter the income so computed shall be apportioned. It has to be just split amongst each co-owner as per their specific share. As simple as that. So calculation can be done as joint property, just one property, as if it is owned by one owner. Then it can be split into 3 or 4, whatever the number of co-ownerships are, according to their percentage of share. So it's just an arithmetical exercise, nothing special here. But key point here to be noted about this is, what if this is a self-occupied property? Let us say some portion of this is self-occupied by some of the owners. Let us say there are 4 co-owners, A, B, C, D. Okay. Out of them, A and B have let that out. C and D are self-occupying, let us say. So for let out portion, there is no issue. A and B will be taxable under the income from house property as usual. There is no issue in that. Question comes about C and D. Why there is a problem with that? Because for C and D, what will be the annual value since it is a self-occupied property? Nil. That is not a problem. But what will be the interest that can be claimed as deduction by C and D is the question. We know that there is a limit of 2 lakhs rupees subject to certain conditions and 30,000 rupees in some other cases. For self-occupied property, limit is there. Now only point is this 2 lakhs and 30,000 jointly for C and D put together, or each of them can claim separately 2 lakhs and 30,000? That is the question. Don't answer that question because we are not the ones to answer that. Law has to tell that. The point here is each co-owner shall be entitled to a deduction of 30,000 or 2 lakhs as the case may be. That is the point. Which means C also can claim 2 lakhs or 30,000 as the case may be. D also can claim 2 lakhs or 30,000 as the case may be. Of course, we know that in case of self-occupied property, the total deduction cannot exceed 2 lakhs. It cannot be 2 lakh 30,000. No, not possible. Total deduction cannot exceed 2 lakhs. That is for sure. But is this 2 lakhs for the house or for the SSC? Now what is that proven? It is for the SSC. So for each SSC, there is a 2 lakhs deduction or 30,000 deduction as the case may be. So that is a point to be noted here, very important in terms of co-ownership, particularly self-occupied property. That's it. Of course, if this SSC, let us say one of the co-owners like C owns another property that is also self-occupied. So can he claim 2 lakhs here and 2 lakhs there? No, not possible. Total deduction under section 24B for one SSC, 24B itself means interest on the loan or capital that is borrowed. So that in case of self-occupied property, total amount of deduction for one SSC cannot exceed 2 lakhs. Whether it is from this particularly co-owned property or some other property, doesn't matter. Total deduction cannot exceed on a whole 2 lakhs. Okay, that is a point to be noted. Of course, 30,000 if it is only for the purpose of repairs, etc. Or if the loan is taken prior to 1499. So like that, in case of co-owned property, if it is a self-occupied property, each co-owner has the eligibility to claim deduction of 2 lakhs or 30,000 rupees, as the case may be. That is limit for SSC, not the limit for a house. That has to be interpreted from that provision of section 26. So 22, 23, 24A, 24B, 25, 25A and 26. These are the core provisions of income from house property, head of income. Now, illustration 11, let us quickly go through that. Miss Aparna co-owns a residential house property in Calcutta along with her sister Miss Dimple, where her sister's family resides. Both of them have equal share in the property and the same is used by them for self-occupation. See, both of them are using for self-occupation. Aparna also, Dimple also. Both of them are using for self-occupation. Interest is payable in respect of loan of 50 lakhs rupees at the rate of 10% taken on 1/4/2019 for acquisition of such property. In addition, Aparna owns a flat in Pune in which she and her parents reside. So she has taken a loan of 3 lakhs rupees at the rate of 12% on 1/10/2019 for repairs of the flat. Flat is here Pune. Compute the deduction which would be available to Aparna and Dimple under section 24B for the assessment year 21-22. That's what is asked here. First of all, Aparna, if you take, she has two different properties. Both of them are self-occupied. It is possible, there is no problem here. Up to two properties, they can be self-occupied. So Calcutta house property is also self-occupied by Aparna, and even Pune flat also is self-occupied by Aparna. But total deduction that she can claim on the interest cannot exceed 2 lakhs. That is for sure. Ultimately, let us look at what kind of interest that Aparna or Dimple have to pay. First thing first, the joint property, that is the Calcutta property, 50 lakhs into 10% means 5 lakhs. That is for the property. If you split that into 2,50,000 and another 2,50,000. Right? So for Aparna 2,50,000, for the other one, Dimple 2,50,000. Let us look at Dimple first. Dimple has only one property. So can she claim 2,50,000? Not possible. It has to be restricted to 2 lakhs. So what is the deduction that can be claimed by Dimple? 2 lakhs, that is clear. What about Aparna? 2,50,000 is there for this property. And in case of Pune property, she has 3 lakhs loan at the rate of 12% means 36,000, which was for repairs. That is restricted to 30,000. Total looks like 2,80,000. But once again, as we know, total deduction cannot exceed irrespective of the number of properties she holds. Under 24B, if it is a self-occupied property, total deduction cannot exceed 2 lakhs. So what is the final answer? For both of them, maximum deduction that they can claim is only 2 lakhs. It doesn't matter. So that's it. That is the final answer. 2 lakhs is the deduction. 2 lakhs is the deduction. Next, section 27 is a theoretical question, possible to be asked as a theory question. That is deemed ownership. Deemed means, though legally the SSC is not the owner, the law, Income Tax Act under section 27, it says the following persons will be deemed to be the owners of the property. So this can be asked as a theory question. Legal ownership is not required always. Even if the SSC satisfies any of these conditions or any of these falls under any of these categories, that SSC will be deemed to be the owner of the property, irrespective of whether he is really the legal owner of the property or not. First thing first, transfers to a spouse. This is a type of provisions. So some of them we will see once again in the another chapter called clubbing provisions. But these are contained in section 27. So now we have to read them. Then once we move to the section, once we move to the clubbing provisions, those cases we'll just have to refer them back. That's all. So now we know this. Section 27 says if any property is transferred by an individual, naturally spouse will be there only for individual. So if there is a transfer of house property by an individual to his or her spouse, spouse is by gender, so it could be husband, wife, anything. So if a husband transfers to wife or wife transfers to husband, transfer of house property is happening. How is it happening? Otherwise than for adequate consideration. Otherwise than for adequate consideration means without adequate consideration. Then the transferor is deemed to be the owner of the transferred property. So legally, let us just take an example for understanding, not that always it should be like this only. It can be reverse also. Let us say husband transferred the property to wife just like that. Husband has a property, he registered the property in the name of his wife. He can do that. Nobody stops them. But the question is, as far as income from house property is concerned, who is considered to be the owner of the property? Husband only, but not wife. Why? Because he transferred the property to spouse without adequate consideration. So, legally who is the owner? Wife is the owner. But according to section 27, who is the owner? In whose hands the assessment should happen? Husband's hands. The transferor is deemed to be the owner of the property in case if he transfers it to spouse without adequate consideration. Otherwise than for adequate consideration means without adequate consideration. Now that there is a point of adequate consideration, that is also another case law, is love and affection and adequate consideration. Somebody argued that I transferred the property to my spouse out of love and affection. Love and affection is the adequate consideration, he argued in the court. Court said, no, love and affection is not an adequate consideration. When we say consideration here, it has to be monetary consideration. So, anybody transferring the property without monetary consideration to the spouse, no problem, they can do that. Nobody is saying they cannot do that. That is their wish, and nobody stops them to register the property in their spouse's name. No problem. But what is the Income Tax Act impact of it? The transfer is as good as invalid because Income Tax Act is ignoring the transfer. Though legally the transferee holds the property, Income Tax Act still says transferor is deemed to be the owner of the property. So all the assessment under section 22 here, because 22 requires a SASI to be owner of the property. So income from house property will be computed, everything happens, all the assessment, taxation, everything happens in whose hands? Transferor's hands. But is he the legal owner? No. Still, he is deemed to be the owner. That is section 27, one of the provisions. Of course, there is an exception here. In case the transfer is in relation to an agreement to live apart, then the transfer will not be deemed to be invalid. So the transferor will not be deemed to be the owner. So naturally, whoever is the legal owner, transferee will be the owner of the property. So only case where this transfer is recognized by the Income Tax Act as valid is when such transfer happens in connection with an agreement to live apart. If they are staying apart out of with an agreement, then such transfer is valid for this purpose. Of course, it is valid legally elsewhere anyway. But for the purpose of income from house property, for the purpose of Income Tax Act, it will be also valid. Means legal owner will be taxable. The deemed ownership provision will not apply in such case. When, if such transfer happens with an agreement to live apart, that is the only exception to that. Of course, love and affection cannot be adequate consideration is one more point to be noted in that particular scenario. That's it. That is one of the deemed ownership provisions. Same logic applies to another case of transfer where the transfer happens to a minor child. Same thing. Logic is same. Transfer is happening of what? House property. By whom? An individual. To whom? To his or her minor child. Minor child could be here anybody, boy or girl, or somebody else. Otherwise than for adequate consideration, then the transferor would be deemed to be owner of the house property transferred. Same logic, only the transferee has changed. Earlier the transferee was a spouse, here the transferee is minor child. In both cases, if SASI, the transferor has transferred the property without adequate consideration to the transferee, the transferor still will be considered or deemed to be the owner of the property, even though he is not the legal owner. That's it. But there is an exception here. One exception only. This is important exception because MCQ type questions can come. In case this transfer is happening to a minor married daughter, then the transferor is not deemed to be the owner. Then naturally, who will be deemed to be the owner? Whoever is the legal owner, that is minor married daughter. So if the transfer here, minor child, the other minor child who is the transferee, If that transferee is a minor married daughter, then this deeming provision will not apply. Then legal owner, who is a minor married daughter herself, will be considered to be the owner of the property. So here one particular point is given. That is why it is important, since it is particularly gender specific. Other normally minor child means anybody it could be. But exception is not given to everybody. Exception is given only to minor daughter, that to minor married daughter. So if there is a minor married daughter to whom the transferor has transferred a property, that is a valid transfer. There is no deeming provision. Who will be the SSC? Who will be deemed to be owner? Who will be actual owner actually? There is no need to deem. She is the owner. Minor married daughter herself will be the owner of the property. No deeming provisions will apply in that case. Now, naturally, a question comes, how can a minor daughter be married? That is none of our business. We are not here to invoke and apply all the Indian Penal Code provisions and all the other acts to safeguard the citizens of this country. That is none of our business. We have to understand that very clearly. We are talking about Income Tax Act. All other acts are different. Maybe the person who has transferred the property will go to jail because he got his minor daughter married. That is none of our business. We are not bothered about that. Don't even think about that. Don't even think about other laws. We were not bothered about that. Income Tax Act, what it says, that is the only thing we have to understand, and we have to look at. All the other laws, they will be in place. Those are there. There are people to enforce them. Police are there. They will take care of it. Courts are there. You and I don't have to worry about them, please. So focus on the provision rather than all the other social things and other criminal things. Is it really legal and all? Let it be. Who said everything has to be legal? In Income Tax Act, there is no need like that. What is the treatment under Income Tax Act is the only focus for us. Everything else is none of our business. That's completely outside the purview of this discussion under the Income Tax Act. That differentiation is important. Otherwise, people will mix up things unnecessarily. What common sense they have, general knowledge they have, all those things if you mix up unnecessarily, where required you have to use that. Unnecessarily, if you mix that up here, then there is no logic in that. So here also there is no logic. We don't know why they said that. Okay, fine, whatever it is. Law said that, law, whatever it says is final. That's all. But why the deeming provisions applied, that we can understand. Why transfer to a spouse or transfer to a minor child without adequate consideration is almost as good as ignored by the Income Tax Act, because this could be dummy transfers. For a spouse name, so if somebody registers the property, he just wants to make sure he is not getting the property, is not getting the income taxed under his name. He is just transferring the tax liability to spouse's name or minor child's name. That is the way they try to evade the tax or transfer the tax burden to somebody else. Then you may say, why they would do that? They would do that, why? Because each individual has a basic exemption limit. These things, nobody, like companies and all, they cannot do that. They don't need to do that because there is no slab system there. In case of individuals, the slab system of taxation is there. Imagine if some person is at a higher slab, even if he reduces to some extent some income by transferring some income to the house spouse or minor child, though it is not real. Actually, who will be the person who receives the income? The main person only. But just to namesake, on document, if he tries to transfer the property, accordingly, along with that, if he tries to transfer the income to the spouse or minor child, what happens? Maybe his slab will go down a little bit, but accordingly he can save some tax. So that is a kind of tax evasion. Kind of. But law does not tell all these logics to you. I am doing this because I think that you are a thief. I think that you might be evading tax. Why they would tell all that? They don't need to tell all that. They will tell this is the provision. Dot. We are trying to understand why it could have been introduced, because many people do that. Many people have their properties registered in their kids' names and spouses' names, assuming or thinking that they can avoid tax or shift the tax burden to somebody else within their family. They cannot do that, because ultimately they will be considered to be the owners of the property. Assessment will happen in the hands of transferor. That is a point to be noted. That is a core issue related to section 27. These are the only major two things. Remaining things are just other things. Now, anyway, what if there is a cash that is transferred to spouse or minor child and transferee acquires the property out of such cash? Then what? Then the transferor shall not be treated as deemed owner of the property. Of course, clubbing provisions will be attracted, which we will see later. So imagine if let us just say husband, for example, the one who transfers cash to his wife. He gives some money to his wife and his wife purchases a property with that cash. Even then also is husband the deemed owner of the property? No. In that case, the spouse, the wife herself will be the owner of the property, but clubbing provisions will anyway apply. That we will see them later and separately. That is not required here. Mainly the transfer here should be what? Transfer should not be money. Transfer is of property. Property is being transferred to whom? Either spouse or minor child. How? Without adequate consideration. Then what? Then the transferor shall be deemed to be the owner of the property. That's it. Same way, the holder of an impartial estate will be considered to be the owner of all properties comprised in the estate. This is an old thing, like old jamindars and all kind of people. They used to have a lot of big estates, which may consist of several properties, not just one. Estate is one, but lot of properties may be there. Will each property be individually be registered by in the name of that holder? No. This entire estate is registered in his name. That means he is the holder of that impartial estate, which means he is automatically deemed to be the owner of all individual properties. That's all. No need to go further. No need to dig into Hindu Succession Act and all the other things that will unnecessarily create questions which are not required. So simple point here is impartial estate means that is not possible to be split. Impartial estate means that cannot be split. It has to be as one. But it will consist of many properties. So what is the provision here saying is, boss, if you hold this impartial estate, all properties contained in that estate are deemed to be owned by you. As simple as that. That is the another case of deemed ownership. Same way, member of a cooperative society, etc. A lot of times it so happens the buildings and plots are allotted to people, but the ownership of that will not be in the name of the people. That will be in the name of the society only. They will be just allotted to the people who can own or who can actually enjoy this. Like so many cases it will be like journalists colony, like teachers colony, like that. Not don't go by names I'm talking about. They themselves unite together and they buy a huge plot of land and they will divide among themselves, and each of them will be allotted some portion of that. But legal ownership of that may not be with the individual person. And sometimes it so happens that these people cannot sell the property to anybody they want also without the consent of the society. So basically the cooperative society itself will have control on this entire project. Like this, so many cases will happen. The point is, irrespective of all these legal formalities and other things, how it looks like, who is the real owner of the property? In essence, legally we don't know. But who is the real owner of the property? The one who got this particular building or plot allotted. That's it. So even though legally he may not be the owner, the person who got this plot allotted is deemed to be owner of the property. Though the legal owner could be actually the cooperative society or the company or the association. Doesn't matter. Really, who is the beneficial owner to whom the particular plot or building is allotted? So he will be the legal owner. Like that, everybody individually will be the legal owners of those properties. Though those will be deemed owners of the properties, though they may not be legal owners. That's the another situation of deemed ownership. Person in possession of a property for more than 12 years generally is considered to, sorry, this is different, that is another one. So this possession of the property is called part performance of the contract. There's a lot of other things are there, Transfer of Property Act, Hindu Succession Act. We don't need all that. Simple logic you have to understand. Let us say, imagine there is a sale deed that has been written. There is a seller and there is a buyer. Sale deed is written already, okay, and the buyer has paid money also. Money also has been given, but only point is registration did not happen. Seller gave the possession to the buyer, buyer gave money to the seller, everything happened, only possession did not happen. So what? So just because of possession did not happen, can we say that B is not the owner of the property? We cannot say that. Still B is the owner of the property. So just because the, let us say, sale deed is not registered, let us say this guy is not in India, or maybe registration they want some auspicious movement, till that time they don't want to register. Fine, but everything else happened. Sale consideration is paid or promised to be paid, some advance is paid, possession of the property is already taken by the buyer. Just because some legal formalities are pending, we cannot say the transfer did not happen. Transfer happened. The law says that buyer will be deemed to be the owner of the property, even though it is not registered in his name. That is the point here. Buyer would be the deemed owner of the property, even though that is not registered in his name yet. So legal ownership does not matter. All of them will tell the same thing. Common logic is, in all the cases of deemed ownership, why this requirement has come? Because legal ownership is not valid in these cases. In the first case, legal owner is spouse, transferee, but we say transferor is the deemed owner. Same the case with second case. Legal owner is transferee, minor child, but who will be considered to be the owner, deemed to be the owner, transferor. Third case, legal ownership may not be there for each individual property, but still he is considered to be the owner of all properties to which he is the holder, which is the impartible estate, which cannot be split. Unsplittable estate, we can call it. So that is another situation where legal ownership of individual property he may not have, but still he is deemed to be owner of all the properties contained in that estate. Cooperative society also, legal ownership may be with the society, but still individual plot owners or building owners to whom these plots are allotted, those will be deemed to be owners of the property. Fifth case also similar. When the sale deed happened, possession transferred, money also paid or promised to be paid, just because some legal formalities are pending, that cannot be called as not a transfer. It is transferred. It is not completely legally transferred to the buyer, but still in that case, buyer will be deemed to be owner of the property. That is another scenario of deemed ownership under section 27. The last one is related to a person who is having a right in the property for not less than 12 years. So if anybody stays in a property for more than 12 years, then the person who is staying in that property, the tenant will be becoming owner of the property. Again, don't get any too many ideas and all. Just forget about it. Don't take it too seriously, because no owner will allow anybody to stay for more than 12 years. Legally, it will be a dispute, definitely. But yes, if at all there is a lease deed, particularly over a period of 12 years, automatically the lessee will be deemed to be the owner of the property. Will it happen practically? Will any owner allow that? That becomes kabja. Nobody allows that. So in practice, this is not something that will be generally allowed. So that is why what they do is usually every year they write separate agreements. That's what usually people do. So usually, let us say there is a lease month to month, monthly like that, not exceeding 1 year. Like that, if lease is being given to the tenant by the owner, then that will not be deemed to be the owner. So then this deeming provisions will not apply. Of course, the tenants will get some rights if they have possession of the property for more than 12 years, but that has nothing to do with Income Tax Act. In such case, if at all they are deemed to be the owner, only when that entire right is there for a period of lease for not less than 12 years. So if the lease agreement itself is for 12 years, then only this deeming provision will come. And nobody with brain in this country will give a lease agreement for more than 12 years, because they know very well automatically after that the tenant himself becomes the owner. Owner will be useless fellow. So no owner will be such stupid to give any lease agreement for more than 12 years. So logically, this is not something which is practically possible. But if so, then lessee will be the deemed owner of the property. These are the 6 cases of deemed ownership under section 47. With that, we can conclude all the legal provisions related to the Income Tax Act and income from house property segment of the Income Tax Act. What are all those there? Quickly, you have to do this exercise. You have to revise very well. Section 22 is about the basis of charge. That is the charging section. What are the things to be noted there? We discussed them. You have to revise them very clearly. The lessee should be owner of the property, and property should not be a vacant land. We have to look at property means building or land appurtenant thereto. That is the main point. Then section 23 talks about the annual value of the property, and this procedure is very important. How to compute annual value of the property. First, compare the fair rent with municipal value. Whichever is higher, it has to be taken. That has to be compared with standard rent. Whichever is lower has to be taken. And what we call that? Expected rent. That expected rent will have to be compared with actual rent. What if the actual rent is greater than expected rent? Automatically, actual rent itself is gross annual value. But what if actual rent is less than expected rent? Then we have to check why is that. Is it because of vacancy, or is it because of any other reason? If it is because of vacancy, then also the actual rent will be the gross annual value, though it is lower. But if it is less than expected rent because of any reason other than vacancy, then expected rent is gross annual value. This is the point to be noted. And while calculating the actual rent received or receivable, you have to deduct unrealized rent, if it is there given in the question. Of course, subject to the satisfaction of conditions specified in law. What about the annual value of self-occupied property? Nil. Annual value of deemed to be let out property, has to be taken according to the normal provisions, but we know up to 2 properties only somebody can call them as self-occupied. All properties more than 2 will be deemed to be let out and annual values will be calculated like any other property. Only thing is there will not be actual rent because it is not a really let out property, it is only a deemed to be let out property. Remaining calculations are same. Then what if the property is held as stock in trade? Up to 2 years from the end of the financial year in which the property gets complete by way of getting a completion certificate, the annual value shall be taken as nil. Afterwards, the computations will be once again normal like any other property. That is all section 23. 24 is deductions. 24A is 30% standard deduction. 24B is interest on borrowed capital. While calculating interest on borrowed capital, we have to split that into 2 portions. Pre-construction interest and post-construction interest. Pre-construction interest is allowed as deduction in 5 equal annual installments, and where the pre-construction period starts for computation, that starts from the date of taking the loan or date of starting the construction. So the date of construction beginning, that is a starting point, but starting point will be anyway given directly. Main thing is ending point of pre-construction period. That will be the 31st March, just immediately preceding the date of completion of construction, whatever it is. So pre-construction period will end by the end of the financial year, immediately preceding the year in which the property gets completed. So that will be the pre-construction period calculation. Once it is calculated, pre-construction interest, whatever is calculated, divided by 5 will be allowed as deduction in the previous year. What about post-construction interest, which is of revenue nature? That will be normally allowed, simple direct calculation, entire amount is allowed as deduction. Then what about interest deduction? How much will be? For let out property, no limit, without any ceiling limit. For let out property, 24B deduction will be allowed. But self-occupied property, yes. For self-occupied property, if loan is taken on or after 1499, subject to certain conditions. What are the other conditions? Construction should be completed within 5 years from the end of the financial year in which the capital was borrowed, and in that case, the amount of deduction can be maximum of 2 lakhs rupees. That is maximum. For one property or 2 properties or put together, that is the maximum amount of deduction if the loan is taken after 1499. For what purpose? Acquisition or construction of the house. In that case, only 2 lakhs will apply. What if the loan is taken for acquisition or construction but prior to 1499? Or even if the loan is taken for repair, reconstruction, renovation, etc. Even in that case, the maximum amount of deduction can be only 30,000. Once again, I am repeating, these restrictions only and only apply to self-occupied property. They don't apply to let-out property or deemed to be let-out property at all. So only for self-occupied property that will be available with some restriction. Of course, in any case, the total amount of deduction cannot exceed 2 lakhs, whether the SASI owns one self-occupied property or more than one self-occupied property. Total deduction can never exceed 2 lakhs. That is section 24A and 24B. Then 25 is inadmissible deductions, which is related to interest payable outside India without TDS. Then that such interest, though it is a genuine expenditure, it is not allowed as deduction under 25. Then 25A is about unrealized rent or arrears of rent now received. That will be taxable, of course, in the year of receipt or realization. But a deduction of 30% of rent is received or realized is allowed as deduction. And this will be taxable even if the SSC is not owner of the property in the year of receipt or realization. So these are the main points related to 25A, which we discussed today. Co-owned property is in 26. In this case, for let out property, it is just an arithmetic split. We just have to calculate normally and then split it according to the share of each of the co-owners. But main point here to note is, if it is a self-occupied property, each co-owner will get a deduction of 30,000 or 2 lakhs as the case may be. That is the point there. Each co-owner. So that 30,000, 2 lakhs is not for the property, that is for each SSC. That is the point. And 27 as deemed ownership. So 5-6 points are there. One of that is when property is transferred to a spouse or to the minor child without adequate consideration. That will be not generally recognized, which means the transferor shall be deemed to be owner of the property. Holder of impartial estate is deemed to be owner of the property. Member of a cooperative society, person in possession of the property, in part performance of a contract, will be also deemed to be owner of the property, and persons having a right in the property for a period of not less than 12 years also are deemed to be owner of the property. And as we already just know, if there is a rent received or receivable actual rent we are looking at, and if there is any unrealized rent, that unrealized rent can be deducted from this actual rent received or receivable. That is what usually we do. We don't do this, so don't do multiple types of treatments and all. Don't even look at that. This unrealized rent has to be deducted from actual rent received or receivable only. This is unrealized rent for the previous year. Don't mix that with unrealized rent of 25A. This is unrealized rent 25A what? This was earlier unrealized rent now collected. This is unrealized rent for the previous year. That has to be reduced from actual rent received or receivable. That's it. And if particularly a portion is let out and a portion is self-occupied, it will be separately computed for let out portion and self-occupied portion. So it is just a physical split. So you have to split that property according to the space. So let us say this is 50-50. You have to just split it 50-50 like that. As good as these two are separate properties. Imagine if there is a house, just for understanding purposes. Lot of old houses, even now also in urban and some of the rural places also will be like this. So one house is there which has 6 different portions. All of them are let out. House is one, but 6 portions are there. Oh, how to deal with that? How to deal with that? Rent could be different from each portion. How to deal with that? Annual value will be for the entire house. How to deal with that? No problem. In that maybe 1 or 2 portions are self-occupied by the SASI himself. Remaining 4 portions are let out. Anything like that is happen. Simple. Don't even think about anything complex there. Simply, it can be treated as if it is a separate property. That's all. So there is no one property here for the purpose of computation. It will be treated as if it is separate properties only. Imagine if one owner holds the entire apartment building, and top floor he stays, and all the other, let us say 2-3 floors he gives on rent. 4th floor he stays. That is self-occupied. These 3 are rented out. So how many properties he has? 4. Building is 1. So we have to understand that he has 4 different properties that will be deemed to be 4 or considered to be 4 different properties. Then a question comes, sir, what about Ambani, who has a tall building, maybe 20 floors like that? What are the number of that building is? Then will that be 24 properties? No, sir. In that case, it is only 1 property. Why? Because he is occupying the entire property. Entire property is in his name only. So he is not having any split in that. So when the portion is given on rent, that portion can be treated separately. That is, can be even for the purpose of computations, treated as if it is a separate property. That is the end of theoretical and provision related discussion for this particular chapter, income from house property. Now let us solve some of the questions here at the end of the chapter in the ICA material. Question number 1. Raman is a co-owner of a house property along with his brother holding equal share in the property. Equal share. Okay. What is the municipal value of the property? That is 1,60,000. Fair rent is 1,50,000. Standard rent is 1,70,000. Rent received is 15,000 per month. This is for the entire property. You have to understand, it is not only his share. So he has a equal share, but the entire property has this details. First thing first, we can understand how to compute the gross annual value, but of course presentation has to be very clearly written, better like this, with a clear working notes. Computation of gross annual value. What is the gross annual value? Take the details first. Municipal value of the property 1,60,000. Fair rent is 1,50,000. Whichever is higher. So municipal value is higher, so 1,60,000 will be taken first. That 1,60,000 is compared with standard rent. Then whichever is lower, that is 1,60,000 only. So that is the 2 steps here. First 160 and 150, which is higher, 160. Then 160 and 170, which is lower, 160. That should be compared with actual rent. Actual rent how much? 15,000 per month means 1,80,000. In this, whichever is higher. So gross annual value will be higher of these two. This is the best way of showing the gross annual value computation for any question, not only for this question. This is the presentation wise. Computation of gross annual value should be shown in the working notes for sure. That will get its own marks. Taking municipal value, fair rent, whichever is higher, compare with standard rent, whichever is lower, compare with actual rent, depending upon situation, normally whichever is higher. So 1,80,000 is the gross annual value of the property directly. That is the first point. Next, Look at the further things. The loan for construction of the property is jointly taken and interest charged by the bank is 25,000, out of which 21,000 has been paid. So this is irrelevant. We have to keep this in mind. Unnecessary information will be given. Is there 24B allowing provision anything related to payment there? No, it is payable, which is allowed as deduction. Payment, how much, doesn't matter. So this 21,000 is a trap. Don't fall for that. Interest on the unpaid interest is 450. Is that allowed as deduction? No. That is also another point. Interest on interest is not allowed as deduction. What is allowed as deduction? Interest on capital borrowed. So only that much is allowed as deduction. Interest on interest is not interest on capital. So how can that be allowed as deduction? Not allowed as deduction. So this 450 is not allowed as deduction. But to repay this loan, Raman and his brother have taken a fresh loan and interest charged on that loan is 5,000. That is allowed as deduction. So when a loan is taken freshly to repay the old loan, just loan got replaced, that is also interest. So definitely that will be allowed as deduction. So what is the interest deduction here allowed under 24B? That comes to 25 plus 5, 30,000. Of course, half of that only will be for Raman. Municipal taxes of 5,100 have been paid by the tenant. Will that be allowed as deduction? No. Municipal taxes have to be paid by owner, not by tenant. What is required? Compute the income from this property chargeable in the hands of Mr. Raman for the assessment year 21-22. Ideally, we better compute it for the property fully. Then how much is Raman's share? That can be taken. That is the easiest manner. Let us take like that. Already we know the gross annual value, 1,80,000. Municipal taxes are not allowed as deduction. Why? Because they are paid by tenant. So net annual value also is 1,80,000. So naturally 30% of net annual value, you have to do these calculations on paper, 54,000. And how much is going to be the 24B as we just now computed? 30,000. Total is 84,000 deductions under 24A and B together. Then after deducting these are from 1,80,000, what is the income from house property? Total for the entire property 96,000. But what is Raman's share? Question is, how much is Raman's share in that? Property, income from house property, chargeable to tax in the hands of Raman was asked. Half only because he is the equal owner. 96,000 divided by 2 means 48,000. That's it. So answer is 48,000. Just normal calculation. But after everything is done, give some percentage to each of the co-owners. That's all. Now points to be noted here, important ones. Interest on housing loan is of course allowed as deduction under 24 on accrual basis. So payment of 21,000 is irrelevant. Further, interest on fresh loan taken to repay the old loan is also allowable as deduction. That is also what we have given as 5,000 rupees. However, interest on unpaid interest is not allowable as deduction under section 24. This is the important point to be applied in this entire question. Remaining things are straightforward. And of course, when co-ownership is there, section 26 will be invoked, wherein the computation has to happen as if the property is owned by one person, and then after that it has to be apportioned according to the shares of each of the co-owner. That's what we did. 96,000 is the original income from house property. Half of that is belonging to Raman, which is 48,000. That's all. That is question number 1 or illustration 1. Then question number 2. Question number 2. Mr. X owns one residential house in Mumbai. The house is having two identical units. First unit of the house is self-occupied by Mr. X and another unit is rented for 8,000 rupees per month. The rented unit was vacant for 2 months during the year. Particulars of the house, each word is important. It's not for one portion. House for the previous year 2021 or as under. Standard rent, municipal valuation, fair rent, these are given. Then municipal tax is paid by Mr. X. Mr. X is our SASI. That is good. 15% of municipal valuation. See these all things. Light and water charges, unnecessary information. Where is it? Any deduction is there for that? No, no deduction. For that there is no deduction. Then interest on borrowed capital, of course there is deduction. Lease money, no deduction, useless. Insurance charges, repairs, no deduction, useless. All this is useless information. Completely irrelevant information, just to confuse and trap those who are ready to fall in that trap. Compute income from house property of Mr. X for the assessment year 21-22. So in these cases, better that we do it like 2 columns, because one of those things is self-occupied and one of that is really let out. So let us take them one by one. One is self-occupied. Headings and all same. Every time you don't have to talk about that. One is self-occupied, one is let out. What will be the heading? Statement showing computation of income from house property of Mr. X for the assessment year 2021-22. Of course, you have to do that in working notes separately, but now we are doing here only. Let us compare these things one by one. Municipal valuation and fair rent, first we should compare. Just because standard rent is given, we cannot start with that. Municipal valuation and fair rent, whichever is higher, 1,90,000 is higher. So 1,90,000 should be taken first of all for the entire house property, that is. Then that has to be compared with the standard rent, whichever is lower. So 1,62,000 is lower. But that is for the entire house property. How much is the let out portion? Only for half. Two identical units is said. So 81,000 is going to be the expected rent for let out portion. But how much is the real rent for that let out portion? 8,000 per month. 8,000 per month, and it was vacant for 2 months. That means 80,000 is the actual rent that is received or receivable. But point is, here, how much is the actual rent received or receivable? 80,000, because 10 months only it was let out. It is less than the expected rent for sure. This is actual rent. Why is it less than expected rent? Is it because of vacancy or any other reason? Of course it is because of vacancy, because if it was not vacant, then it would have been 96,000. Because it is vacant, the actual rent is only 80,000, which means the actual rent is less than expected rent only due to vacancy, which means actual rent itself will be the gross annual value for the purpose of second portion, that is let out portion, 80,000. What about first portion? First portion is what? We don't need to do like this separately. Just one straight calculation with 2 columns is enough. For first portion, which is self-occupied, naturally it will be nil, because always that is going to be nil only for self-occupied portion. Next, coming to municipal taxes. Municipal taxes are 15% of municipal valuation. No such deduction is available here for self-occupied portion. Be careful here once again. Municipal taxes 15% of what? 15% of municipal valuation. 1,90,000 is the total value of the property. On 1,90,000, 15% means 28,000. 28,500, isn't it? 1,90,000, 15%, 28,500. But half only, because let out portion is only half. So 28,000 divided by 2 only will be allowed as deduction for municipal taxes. So naturally, whatever the net annual value is, that will be this much, 0 and 65,750. That is net annual value, 65,750. Now, from that, deductions under 24A and 24B will be available. So let us take 24A. B. 24A will be nil here naturally, and here it will be how much? 30% of net annual value. So that is 24A. Coming to 24B, what was the amount given? Interest on borrowed capital is 1,500 per month. That will be 18,000 per annum. That 18,000 can be split into 2 portions. One is self-occupied, one is let out. So 9,000 and 9,000. So what is the income from house property now? Net annual value minus of deductions. That will be the income from house property separately for the self-occupied portion and let-out portion. But what will be the combined amount? After this, you can do the combination of these two. Ultimately, 47,750 will be the answer. But separately, we have to show that 9,000 and 56,750. Is that the calculation? 19,750. 725. Yeah, that is correct. This calculation is wrong. 65,750 or our calculations wrong. One more thing is there, correct. We are wrong. 65,750 minus of 19,725 minus of 9,000, correct. 37,025, correct. You missed one thing there. So that 37,025 is the income from house property from the let out portion. From the self-occupied portion, it is 9,000. Total is 28,025. That's it. That is the final answer combined for both the properties put together. Right? That was question number 2. Now, question number 3. Mr. Vikas owns a property whose municipal value, fair rent and standard rent are like this: 96, 126 and 108,000 per annum respectively. So municipal value, fair rent, whichever is higher, 126,000. 126,000 higher compared with standard rent 1,08,000, 1,08,000. So first thing first, from observation, 1,08,000 is going to be the expected rent of this property. Keep it aside. During the financial year, 1/3 of the portion of the house was let out for residential purposes at a monthly rent of 5,000. Remaining 2/3 portion was self-occupied by him. Municipal tax of 11% of municipal value has been paid during the year. Construction of the house began in June 2013 and completed in 31st May 2016. And Vikas took a loan of 1 lakh on 1/7/2013 for the construction of the building. So the construction started on June, loan taken on 1/7/2013. So when the pre-construction period will start, whichever is later only. So 1/7/2013 the pre-construction period will start. When it will end? So pre-construction period is the important point. 1/7/2013 is the starting date. 31st March guaranteed. Of which year? 2016 it will end. So pre-construction period calculation of interest has to be done, and he paid interest of 12% per annum, and every month that interest was paid. So interest on loan is 12%. Compute income from house property of Mr. Vikas for the assessment year 2021-22. See, the way we have to calculate is same. The format is more or less the same, only the amounts will change. So let us take as the earlier thing was self-occupied portion, let out portion. So self-occupied and let outs separately. For self-occupied, there is no problem. Gross annual value, municipal taxes, net annual value, 24A, all of them will be same, 0000. Only 24B calculation will come. For let out portion, we will see that. For let out portion, 1,08,000 was the expected rent. 1,08,000 expected rent. Out of that, how much was let out? 1/3 was let out. 1/3 was let out means expected rent for the let out portion will be how much? 36,000. 36,000. That will be compared with what? Actual rent. Monthly rent of 5,000 rupees was received. That monthly rent 5,000 means 60,000 rupees is the actual rent received from that let out portion. Naturally, whichever is higher, 60,000 will be the gross annual value of this property. Now, municipal taxes are 11% of municipal value. Always be careful. Municipal value is here 96,000. 96,000, 11% means 10,560. But in that, one third only will be given as deduction here. 3520 will be given as deduction only for the let out portion, because for the self-occupied portion there is no deduction of municipal taxes. 3520. So the net annual value for the let out portion is 56,480. 56,480 is the net annual value. So far it is just straightforward. Nothing special. Calculations are to be shown in the working notes, of course, or in the bracket also. For municipal taxes, you can show in the bracket. Then 30% is 16,944. This is also okay. So what is the only thing in this particular case? What is the only calculation that you have to do is interest on the borrowed capital. Interest on the borrowed capital to be calculated carefully in the working notes. What is the interest here? First of all, 12% per annum. How much is the loan? 1 lakh rupees is the loan. 12% per annum means per annum it will be how much? Naturally 12,000 rupees. That means per month it will be how much? 1,000 rupees. First thing first. That calculation has to be shown. 1 lakh into 12%. Per annum it is 12,000. Per month it is 1,000. Why do we need per month? Pre-construction period you can find out in the number of months so that it will be easier. Now look at the years here. 1/7/2013. So July, August, September, October, November, December, January, February, March. 9 months are there in 2013-14. Then 12 months are there in 2014-15. Then another 12 months are there in 2015-16, because 14, 15, 15, 16 are full years. For 2013-14 it was only 9 months. So how many months interest will be pre-construction period? 12 plus 9 means 33 months is the pre-construction period. That means 33,000 is going to be the pre-construction interest. If 33,000 is the pre-construction interest, how much can be given as deduction? Only 1/5 of that can be given as deduction, which is how much? 13,200. That is the pre-construction interest. Plus, in addition to that, current year interest will be there, post-construction interest, because construction completed long back in 2016 itself. So current year's interest will be how much? Current year's interest will be 12,000 naturally. 1 lakh on 1 lakh 12% means 12,000. So total will be 25,200. This has to be split. This 25,200 has to be split. Like what? 2/3 and 1/3. 1/3 how much? 8,400. 2/3 will be 16,800. That is the overall interest. I think once again calculation went wrong here. 33,000 by 5. How did we get 13,200? I don't know. It has to be 6,600, right? 33,000 divided by 5. 6,600. So 6,600 plus 12,000. 6,600 plus 12,000 will be how much? That is 18,600. This has to be split into 2. 6,200 1/3, 12,400 2/3. So it's 12,400 for the self-occupied portion. That is 24B, 12,400. And for the let out portion, it will be 6,200. That's it. So after this, the final income from house property put together will be 20,936. That's all. So this pre-construction interest calculation is important. How many months it was? 33 months. That is all okay. 33,000 each month 1,000, that divided by 5. 6,600 will be allowed as reduction in the current year, plus 12,000 anyway for the post-construction interest, which is the revenue expenditure. Total of 18,600 split into 2 portions. 1/3 for let out, 2/3 for self-occupied. That's it. By doing so, we got final answer 20,936. That is one more thing. Now moving on to question number 4. Mrs. Rohini Ravi, a citizen of USA, is a resident and ordinarily resident in India. That means every income is taxable, global income is taxable. She owns house property at Los Angeles, USA, which is used as a residence. That is a self-occupied property. Annual value of the house is $20,000. We don't care. The value of $1 may be taken as 75 rupees. So that is a self-occupied property. But now, in addition to that, she took ownership and possession of a flat in Chennai on 1/7/2020, which is used for self-occupation also. So this is also self-occupied property. While she is in India, the flat was used by her for 7 months only during the year ended 31st March 2021. Municipal valuation is 3,84,000 per annum. Fair rent is 4,20,000 rupees per annum. And she paid the following to the Corporation of Chennai: property tax and sewerage tax. Both are allowed as deduction. Property tax, municipal tax, sewerage tax. Those are all taxes to be paid to municipal authorities, whatever the name they are. They are all allowed as deduction. But the another point is, she has taken loan from Standard Chartered Bank in June 2018 for purchasing this flat. Interest is like that. Prior to 1/4/2020, 49,200. After that, 1/4/2022, 30th June, and from July to 31st March, both of them are post-construction only. But 49,200 will be allowed only in 5 equal installments. 49,200 divided by 5, 9840. This is a completely post-construction, so fully allowed as deduction. You don't have to split that period between real construction date and after the construction date. So 1,82,100 post-construction. So 182,100 plus 9840, that is 1,91,940. That is the interest here. She had a house property in Bangalore, which was sold in March 2017, already long back. In respect of this house, she received arrears of 60,000 in March 21, that is our previous year. This amount has not been charged to tax earlier. Compute the income chargeable from house property of Mrs. Rohini Ravi for the assessment year 21-22. So she is ROR, of course, global income is taxable because she has 3 properties. Out of them, she has only 2 properties during the previous year. Both of them are self-occupied, so naturally for both of them, the gross annual value will be nil only. So there is not going to be any separate thing. So both of the properties have gross annual value and net annual value, everything is nil. So ultimately there is no taxability as far as annual value is concerned. So how much will be the interest on borrowed capital here? That we already calculated. 1,91,940. 191,940 is the interest. So the negative income from house property will be 191,940. That is for both the properties, both are self-occupied. Now for the Bangalore property, which is not owned by her during the previous year, but still it is taxable according to 25A, since arrears are received now in the previous year. 60,000 are the arrears received, and we know that under 25A, deduction of 30% can be allowed. So how much is taxable amount out of this? 42,000. So minus 191,940 plus 42,000. So what is the final income from house property for her? 1,49,940. That's it. That is the final answer for question number 4. 191,940 was the interest, and final income from house property is 149,940 negative. That is loss from house property, we can call it. That was question number 4. Then question number 5. 2 brothers, Arun and Bimal, let us call them A and B, are co-owners of the house property with equal share. Property was constructed long back, 98-99. It consists of 8 identical units and is situated at Cochin. So it has 8 identical units. During the financial year 2021, each co-owner occupied 1 unit for residence, and the balance of 6 units were let out at a rent of 12,000 rupees per month per unit. Municipal value of the house property is 9 lakhs, and municipal taxes are 20% of municipal value, which were paid during the year. Other expenses are like this. These 2 are irrelevant. Repairs we don't care. Insurance premium we don't care. So these 2 are completely irrelevant. Interest payable on loan taken for construction of the house, yes, it will be relevant. One of the let out units remained vacant for 4 months during the year. One of the let out units was vacant. Arun could not occupy his unit for 6 months as he was transferred to Chennai. He does not own any other house. So no problem. Still it will be still deemed to be considered as a self-occupied property only, because that property was unoccupied due to non-existence of that SSE in the same city because of employment elsewhere. So still it is self-occupied, still the annual value of the property, such property will be nil only. And the other income of Mr. Arun and Bimal are 2,90,000 and 1,80,000 respectively. Compute the income under the head income from house property and the total income of two brothers for the assessment year 21-22. That's what is given here. Simply whatever the self-occupied portion is there, those are the two different things, and remaining things are all 6 units which are all related to let out portion. For that, calculation can be separately done. Let us do this separately for A, Arun, B, Bimal. For self-occupied portion only first. Only for self-occupied portion. Naturally, there is no special thing here. Naturally, all will be 0, 0, 0. So all will be 0, 0, 0 for self-occupied portion. Only for 24B interest we need to know. What is interest here? Interest payable on loan taken for construction of the house was 3 lakhs rupees. That is already given, not required to be calculated separately. So out of 8 identical units, 3 lakhs rupees means 3 lakhs divided by 8, each unit will be 37,500. That is the interest. So same will be for Bimal also, 37,500. So if at all we need to compute the income from house property from the self-occupied portions, $37,500, simple for Arun and Bimal for the self-occupied portions. Now keep that aside and compute for other portion, which is let out portion. That can be done combinedly, then we can split that. We'll come back to this later. So leave some space, then we'll do for the let out portion. For the let out portion, there will be other things also. Gross annual value, everything will have some values. So let us look at that. This is what? Let out portion. Let out portion, how many? 6 out of 8. 6 out of 8. 6 by 8 we can call it. Or even it can be just called as 75% let out of the total. So let us look at one of the things. Municipal value of the property is 9 lakhs. When municipal value of those property is 9 lakhs, how much will be for the 6/8 portion? So separately if we calculate municipal value, 9 lakhs into 6 by 8, that will be 6,75,000, right? Then actual rent is how much? Let out at a rent of 12,000 per month per unit, and municipal value is 9 lakhs. Municipal taxes are given later, that's okay. So what is the fair rent and all? Not given. When it is not given, not there. When there is no standard rent, not there, no problem. Simply what we have to look at is actual rent. Actual rent received is how much? Really received is how much? That we have to look at. Why? Because there is a one unit. It was mentioned that one of the let out units remained vacant for 4 months during the year. That means remaining units definitely got the full month rent, full rent. Okay. How much was the monthly rent? 12,000 per month per unit. Totally we are looking at 6 units. Out of them, 5 units, 12 months, 12,000 per month fully they got. 1 unit, 4 months vacant means only 8 months, 12,000 rupees it would have got. So simply this calculation, if you show it separately and do it, 5 into 12 into 12,000, 7,20,000, 8 into 12,000, 96,000. Total 8 lakhs 16,000. So actual rent received is how much? 8 lakhs 16,000. It is already higher than expected rent. So naturally that itself will be taken as gross annual value 8 lakhs 16,000 for the 75% portion. One more point is there. The date is given here. When the property was completed construction, 98-99. And for the self-occupied portion, we have a restriction because if the loan is taken prior to 1499, maximum amount of deduction can be only 30,000. Do we know when the loan was taken? We don't know. But construction itself completed in 98-99 means naturally we have to assume that loans would have been taken prior to 1499. With that assumption, self-occupied portions will have negative income from house property of 30-30. That will be correct. 30-30 rather than 37,500 because assuming loans would have been taken prior to 1499 since the date of completion was 98-99. That is a valid assumption. It should be taken. Then coming to the 75% portion. In the 75% portion, how much was the gross annual value as we have taken just now? That should be 8 lakhs 16,000. Then municipal taxes. Municipal taxes given in the question as what? How much is the municipal taxes? The 20% of municipal value. 20% of municipal value means 1,80,000 because 9 lakhs is the municipal value. On that 20% means 1,80,000 is the municipal taxes. But how much we have to take? Only for 6 units we have to take into 6 by 8. So 1,80,000 into 6 by 8 or 75%. That is 1,35,000 can be claimed as deduction. So what will be the net annual value naturally? $6,81,000. Then 24A will be automatically on that 30%, whatever it is, 2,04,300. Then 24B. 24B, out of these 3 lakhs, how much will be allowed? Entire amount, any amount will be allowed. 3 lakhs already we have taken out. This 3 lakhs is for 8 units, right? So into 6 by 8 simply. So 3 lakhs into 6 by 8 means 2,25,000 is 24B. Then finally 2,51,700 is the income from house property for the entire property of 6 units. But that is co-owned by 2 people. So this has to be split into 2 portions. So how much will that be? This divided by 2. 125, 850 for each of them. So let us add that here. From the let out portion, whatever the amount that is coming, that will be 125,850. Same amount will be for the other person also because they have equal share. And other incomes are given here because the question asked is total income was also asked. So other income of Arun is 290 and for Bimal it is 180. So add that also. So first of all, income from house property, how much? Let us do that. Income from house property will be the total of these two. Same amount. 95,850. Then other incomes. Other incomes are 290 and 180. 290,000, 180,000. Then what will be the total income? For each of them, naturally, it will be different. Why? Because other incomes are different. So final answer will be for Arun it is 385 is the final answer. 385,850 it should be, and for Bimal it should be 275,850. That's all. This is the final answer after adding the other incomes also to the income from house property. That's it. And one of the key points here to be noted is this date of completion of construction. Because it is given, we need to assume that the loan would have been taken before 1499. Remaining things are all same and computations are straightforward using the same provisions, all of them which we discussed as part of this chapter, income from house property. With that, we can conclude this chapter or head of income from house property. We'll discuss some more provisions related to the Income Tax Act under some other head of income in the next session. Till then, take care. Bye bye. Thank you very much.